Hi everyone, welcome back to Difference Frames the World. I am Clara, and today we discuss why the IMF publicly told China to take the brave choice, slow down its export push, and do more to get people in China buying more stuff at home. That's not a gentle hint, but a pretty explicit policy nudge with global ripple effects. Today we unpack what the IMF said and why it matters for China, the US, factories in Vietnam, and all other countries involved. Also, we will cover what could happen next. Along the way, we will go through the data, the politics, and the likely scenarios. IMF staff concluded that China's heavy reliance on exports is increasingly risky, both at home and abroad, and urged Beijing to pivot more forcefully toward consumption-led growth. The fund's immediate concerns are threefold. First, a record trade surplus and rising tensions. China's external surplus has swelled to eye-catching levels, and the IMF warned that this is making trade partners nervous and increasing the risk of retaliatory protectionist measures. Continued reliance on exports could prompt trading partners to curb imports from China. Second, weak domestic demand and deflationary pressure. Despite strong exports, household consumption remains softer than policymakers would like. Low inflation and, in some sectors, outright deflation depress wages and consumer confidence, which in turn keep people saving rather than spending. That is a structural problem for any country trying to rebalance away from investment-led growth. Third, structural risks that require policy action. The IMF recommended a package of measures: more targeted fiscal support for households, more forceful intervention in the property sector, improvements to social safety nets to reduce precautionary savings, and greater exchange rate flexibility. Put simply, China's factories have been humming, and shipping containers have been leaving ports in record volume, but too little of the economic engine's combustion is happening inside Chinese households. What exactly did the IMF recommend? The IMF delivered a fairly standard toolkit of prescriptions, but the tone suggests urgency. Number 1, boost social spending and reduce precautionary savings. Greater investment in health care, pensions, and unemployment protection would make households feel safer about spending instead of hoarding income for emergencies. Number 2, fix the property sector. China's property malaise, such as bankrupt developers, unfinished housing projects, and falling home values, continues to depress household wealth. The IMF urged bolder steps to restructure bad debt, stabilize the sector, and restore confidence. Number 3, allow more exchange rate flexibility. China's low inflation compared with its trading partners has made its exports more competitive. Allowing the exchange rate to respond more freely while using fiscal tools to support domestic demand could help rebalance the economy. Number 4, reduce distortions favoring export industries. The fund wants Beijing to scale back subsidies and support programs that tilt the playing field in favor of chosen export-oriented sectors. Instead, it encourages policies that broaden opportunities for domestic services, private enterprises, and consumption-led industries. The menu is not new, but the IMF is emphasizing that the cost of delay is rising. The data that pushed the IMF over the edge explain why the IMF elevated its tone this year. China's trade surplus has reached unprecedented levels. Large, persistent surpluses signal that domestic investment and consumption aren't keeping up with production. That imbalance worries the IMF because it often triggers political responses from trade partners. The misalignment between exports and consumption is worsening. Exports have been booming, yet household consumption growth has lagged, revealing that China has not completed its long-planned transition to a more consumer-driven economy. Currency dynamics are rigid. China's comparatively low inflation has effectively weakened the real exchange rate, making Chinese exports even more competitive globally. That, in turn, reinforces the imbalance and risks overdependence on external demand. Even as exports to the US face tariffs, China has redirected shipments to other markets, keeping total export volumes robust. The IMF cautions that this resilience may be masking deeper structural weaknesses at home. In other words, the IMF sees a disconnect: strong headline growth driven by exports, contrasted with weak consumer sentiment, weak prices, and a property sector that drags like an anchor. Even if the IMF's advice makes economic sense, implementing it is not easy for Beijing. Exports are politically valuable for the country. They support tens of millions of jobs, generate fiscal revenue for coastal provinces, and reinforce China's centrality in global supply chains. Why voluntarily slow down something that works? Also, the IMF's suggestion sounds more like a conspiracy than advice. Property sector fixes are expensive. Cleaning up developer debts and stabilizing the market requires a serious fiscal commitment, which means political coordination and a willingness to absorb losses. Moreover, speculation may come back, creating another wave of bubbles. Boosting consumption requires social reforms. Expanding pensions and health care, improving worker benefits, and increasing social transfers are politically complex. They also challenge long-standing fiscal relationships between Beijing and local governments. China prefers a strong central government to muscular local agencies, a lesson history has taught Chinese leaders to keep in mind all the time. Industrial policy is central to Beijing's national strategy. The IMF's call to reduce subsidies to strategic sectors runs up against China's stated ambitions in semiconductors, EVs, clean energy, AI, and high-tech manufacturing. These sectors are pillars of national development plans. China has to transform itself from a low-cost manufacturing hub that produces knockoffs to a higher value-add position in the global value chain. It is no longer willing to sell 1 billion shirts in exchange for a Boeing plane. So the IMF is asking China not only to change policies, but to shift deep structural priorities. That is a big political call. The IMF is an organization within the rules-based international order, and China always takes care when dealing with it. The International Monetary Fund, IMF, is often criticized for primarily serving the interests of Western nations due to its governance structure. The IMF's decision-making is based on a country's quota subscription, giving larger economies, particularly the United States, more influence, with the United States being the only country with de facto veto power over major decisions. America's voting share is approximately 17%, which is above the 15% threshold needed to block major decisions that require an 85% supermajority. If we say the IMF is a U.S. organization, it is not too exaggerated. Established in 1944, the IMF has mostly, if not always, been led by a European, while the World Bank has been led by an American, reinforcing Western leadership dominance. As a result, when the IMF imposes policy reforms as conditions for financial assistance, it often aligns with Western economic principles and can negatively impact developing nations. Latin America is known better than any region in the world for the so-called reforms required by the IMF. Critics argue that IMF loans and advice have not effectively fostered economic growth in developing countries, sometimes leading to increased debt and dependency. If someone says the IMF is a credit card company, not a charity, no one should blame them. That said, it is clear whether Beijing should listen to IMF recommendations, even if they sound perfect. Still, China can follow the directions the IMF suggests, as in the long run, the country should voluntarily reform itself. China has several tools at its disposal if it chooses to lean into the IMF's recommendations. These fall into two categories: quick-acting measures and long-term structural reforms. Short to medium-term options include targeted fiscal transfers, such as consumption vouchers, tax rebates, or direct cash transfers, that could boost retail activity quickly, especially among lower-income households with a high marginal propensity to consume. China is doing that. China is also taking selective monetary easing measures. It is lowering borrowing costs for households and service sector firms, which can help stimulate consumption. In the housing sector, even though Beijing is reluctant to buy out bankrupt developers, it can provide liquidity to complete unfinished projects or introduce targeted mortgage easing to shore up confidence. However, the downturn in China's housing sector is taking time to reverse. For the medium to long-term structural reforms, China has always been cautious. Instead of radical, abrupt changes, it takes careful steps to expand its social safety net. The country has provided low-cost health insurance packages for its people, greatly reducing their burdens compared with decades ago. However, it is not easy for the central government to coordinate with local agencies, as many localities still rely heavily on land sales and investment-heavy projects. Transitioning to a consumption-oriented model requires changing how local officials are evaluated and funded. In recent years, China has changed its evaluation metrics for local governments, making them no longer GDP-oriented. It will be a disaster for a large economy to change direction abruptly. Beijing has always cautioned itself against following the example of the former Soviet Union, which collapsed overnight after adopting Western economic advice. It is unfair to say the IMF is intentionally framing China, but Beijing's policymakers are smarter than before. The IMF believes a China less dependent on exports would shrink its trade surplus, easing trade tensions with the US and EU, and reducing political pressure for tariffs. The problem is that China can never fulfill the requests of the collective West, especially the United States, even if it is willing to lower itself to become a vassal state like Japan or Germany. The US also strikes Japan and Germany for its personal gains. The United States has long criticized China's so-called overcapacity, seeking to reshape supply chains. While a domestic demand pivot could alter China's sourcing patterns, more consumer goods and services imports could rise relative to raw materials for industrial production. Firms making long-term supply chain plans would notice. Consumption-led growth changes what China buys. Instead of steel and copper for infrastructure, demand might shift toward food, consumer goods, healthcare services, and travel. If the Chinese learn from Americans, spending tomorrow's money for today's enjoyment, China may become another United States, which is a disaster to the world. As a developing country, a huge disparity between the coastal areas and the inland provinces exists in China, so it is not possible to implement one policy for all regions. Western nations think China is a key deflationary force globally. If its domestic demand picks up, export prices could rise. That would feed into global inflation dynamics and influence monetary policy in advanced economies. However, should anyone in the West think about people in underdeveloped countries in Africa, Latin America, and even Asia? Without China's affordable commodities, how can they improve their livelihoods? The world will suffer more if China cannot produce enough cheap, but reliable stuff for the rest of the world. The West naively thinks countries that supply consumer goods or services to China, from tourism-heavy economies to agricultural exporters, could see significant upside if China rebalances. Still, the reality is that China has already encouraged imports of various goods from underdeveloped entities, and some of those countries even enjoy zero tariffs when selling goods to China. Compared with Donald Trump's tariffs imposed on almost all nations, from Canada to Uganda, China is 10 times better. Markets tend to interpret IMF commentary with nuance. On one hand, stronger Chinese domestic demand is good for global growth and commodity prices, creating optimism in equities tied to emerging markets, services, and travel. On the other hand, large-scale fiscal stimulus in China could introduce new inflationary pressures and prompt central banks elsewhere to adjust policy. Analysts also note that IMF upgrades to China's growth forecast are coming with a caveat: growth is rising because exports are booming, not because the economy is rebalanced. Markets want to see where the next leg of growth will come from, households or factories. Now, let us see what Beijing will respond to the IMF's suggestions. China's leadership has several strategic options. Option 1 is a partial adoption, the most likely scenario. Beijing may embrace some recommendations, such as property fixes and targeted fiscal tools, while avoiding moves that weaken industrial policy or export competitiveness. This approach preserves political control while stabilizing short-term demand. Option 2 is a full embrace, which is possible but unlikely. A bold pivot toward consumption-led growth, including deep social spending reforms and significant retreat from export subsidies, would transform China's economy. But it would also require politically sensitive changes that challenge entrenched interests. Option 3 is resistance. Instead of curbing exports, Beijing is doubling down on exports. If Beijing views export-led growth as essential for employment and technological upgrading, it might continue supporting strategic sectors even if tensions rise with trade partners. This scenario risks a cycle of retaliatory tariffs or restrictions. Realistically, China will mix pragmatism with long-term strategy, stabilize the property market, offer selective support to households, and maintain industrial ambitions. China is now in a dilemma. Too much stimulus, applied too quickly, could reignite asset bubbles, especially in housing. Too little support could leave households unconvinced, prolonging weak consumption. Exchange rate adjustment might create volatility or disrupt planned investments. Local resistance could slow implementation. Local governments may fear revenue losses if they move away from land finance growth. Global impact could create winners and losers. Commodity exporters, such as those in India and Vietnam, may benefit, while others might struggle if China reduces its export push. Customers will face a price hike, further worsening their living situation. The best scenario will be China stabilizes the property sector, boosts social spending, and strengthens household confidence. Consumption grows steadily and becomes the main engine of growth. Trade tensions ease as the external surplus shrinks. It is the long-term goal China wants to achieve, but it is too early to realize, considering today's global environment and domestic difficulties. As a compromise, China may take targeted actions, moderate fiscal support, some property rescue measures, and incremental reforms. Consumption rises slightly, but exports remain dominant. Global tensions cool but remain present. It is also what Beijing is doing nowadays. The results are not clear yet, and it takes time to validate whether the policies are insufficient, consumption stays weak, and the property drag continues. If results are not satisfactory, China will lean harder on exports, creating tensions with major trading partners. The global economy faces a new wave of protectionism and fragmentation. The IMF's request is both technical and political, and it does not say anything radically new, but it is making louder noises and with greater emphasis than in previous years. China's current growth path still leans heavily on exports, while domestic consumption, the long-promised engine of the future, remains underpowered. The IMF believes that, for China's long-term resilience and global stability, the country must accelerate reforms that shift growth toward consumers. That means stepping away from the comfort zone of export-led growth and confronting political trade-offs head-on. China has 1.4 billion people, almost twice as many as Europe, even if we include Russia. Running such a large country demands extreme care and profound wisdom. China haters often point fingers at China and its leaders, but if they are willing to compare their countries and leaders with Beijing and Chinese officials, they may have a different idea. Beijing has its own development path, and its success in the past decades has proved that the country can tackle its problems much better than most nations globally. As for the recommendations from the IMF, our take is that China will focus on the exports and customers at the same time, and it will not abandon either of them, even 100 years from now. Donald Trump can beg China to buy more soybeans and beef from the United States, but why should the IMF ask China to curb its exports?